The stock market can be a complicated place for many, but understanding the basic sectors can give you a strong foundation for making wise investment decisions. A sector is a group of companies that share similar business activities. By investing in stocks from different sectors, you can spread your risk and increase your chances of earning good profits. In this video, we will dive deep into the different stock market sectors and explain how understanding them can help you make smart choices and possibly earn huge profits. First, let's talk about what a sector is. A sector is essentially a category of businesses that operate in similar industries or have similar products and services. When you look at the stock market, you'll notice that the stocks are divided into various sectors. These sectors are like umbrellas that cover different areas of the economy. Investors often track these sectors because they help to predict the performance of different parts of the market. Now, let's go over some of the major sectors in the stock market. Each sector has its own characteristics and behaves differently depending on various economic factors. Understanding these differences can give you an edge in knowing when to invest and how to maximize profits. The first major sector is the technology sector. This sector includes companies that develop and sell technology products or services, such as computers, software, telecommunications, and electronic devices. Companies like Apple, Microsoft, and Google are prime examples. Technology is constantly evolving, and this sector often offers great opportunities for growth, but it can also be quite volatile. Investing in tech companies has the potential to provide huge profits, especially as new innovations and breakthroughs emerge. However, the fast-paced changes in technology mean that stocks in this sector can go up or down quickly, so timing is important. The healthcare sector is another important area of the stock market. This sector includes companies involved in the development and distribution of medical products, pharmaceuticals, biotechnology, healthcare services, and medical devices. Big names in healthcare include Johnson & Johnson, Pfizer, and Merck. The healthcare sector tends to be more stable compared to others because people always need medical services and products, regardless of the state of the economy. However, this sector can also be affected by government regulations, changes in healthcare policies, and breakthroughs in medical science. Investors who understand these factors can potentially earn big returns by picking companies with strong products or promising research and development.
Next is the financial sector. This sector consists of banks, investment firms, insurance companies, and real estate companies. Some of the largest financial companies in the world are J.P. Morgan Chase, Bank of America, and Goldman Sachs. The financial sector plays a critical role in the economy by facilitating investments, loans, and insurance. The performance of the financial sector is often tied to interest rates and the health of the economy. When the economy is doing well, people tend to spend more, take loans, and invest, which boosts the financial sector. However, in times of economic downturn, the sector can suffer as loans and investments decrease. Understanding the market's financial trends can help investors profit from both growth and recovery periods. The energy sector covers companies involved in the production and distribution of energy, including oil, natural gas, renewable energy, and coal. Major companies in this sector include ExxonMobil, Chevron, and NextEra Energy. Energy is a crucial part of the global economy, and fluctuations in energy prices can significantly affect the stock market. When oil prices rise, energy companies can see huge profits, but when prices fall, their stocks may decline as well. The energy sector can provide substantial profits, especially if you know how to trade based on the rise and fall of energy prices. Also, with the growing demand for renewable energy sources, this sector is evolving, and there are opportunities for investors to capitalize on emerging trends. The consumer discretionary sector includes companies that sell non-essential goods and services, meaning items that people may buy more of when the economy is doing well, but may cut back on when things are tough. This includes retailers, automobile companies, entertainment, and travel. Some top names in this sector include Amazon, Tesla, and Nike. Consumer discretionary companies tend to perform better when consumers have more disposable income and people are willing to spend on luxury or non-essential items. If the economy is in a boom, these stocks tend to rise, but they can be hit hard during economic recessions as people cut back on spending. This sector can be a great place for growth during good economic times, but investors should watch economic trends closely to avoid losses. On the opposite side, we have the consumer staples sector. This sector includes companies that produce essential products that people need on a daily basis, such as food, beverages, and household goods. Companies like Coca-Cola, Procter & Gamble, and Unilever are prominent in this sector. Consumer staples are generally seen as more stable investments because people always need these products, no matter the state of the economy. The stocks in this sector tend to perform well in both good and bad times, making them a safer investment option for long-term investors.
While the growth potential may not be as high as in sectors like technology, the stability of this sector can provide steady returns over time. The industrial sector involves companies that manufacture goods used in construction, transportation, and infrastructure development. Key players in this sector include Caterpillar, Boeing, and Lockheed Martin. The industrial sector is closely tied to the economy's overall health. When the economy is growing, demand for industrial goods increases as companies build, transport, and produce more products. On the other hand, during economic downturns, demand for these goods may decrease. Investing in this sector requires understanding broader economic cycles and knowing which companies are likely to benefit from infrastructure projects, defense contracts, and other large-scale initiatives. The real estate sector is made up of companies that buy, sell, and manage real estate properties. These companies can include residential, commercial, and industrial real estate firms, as well as real estate investment trusts, or REITs. Real estate investments can be highly profitable, particularly if property values rise or rental incomes increase. REITs are a popular way to invest in real estate without directly buying property. They tend to offer stable dividends, making them attractive to income-seeking investors. The real estate sector can be affected by interest rates, housing markets, and economic growth, so it's important to pay attention to these factors when considering real estate investments. Another sector is utilities. This sector includes companies that provide essential services like water, electricity, and natural gas. Big names in the utility sector include Duke Energy, Southern Company, and Dominion Energy. Utilities are considered a safe investment because they provide essential services that people rely on. These companies are often less affected by economic cycles, making them a defensive investment during tough economic times. However, their growth potential is typically lower compared to more dynamic sectors like technology or consumer discretionary. That said, utilities offer a stable income stream through dividends, making them appealing for conservative investors looking for consistent returns.